In my vision, 10 years from now, one of the reasons that I think Bitcoin does so well, if Bitcoin is for people who don't believe in the system, you actually need the people who are benefiting the most from the system to not believe the system. They still believe the system because they're making lots of money. The people who call this a bubble, they're all people at the top end of that scale. Mm-hmm. The people at the bottom end are saying, I don't even know why this is going on. There's nothing good happening. So I agree with what you're saying. I just think people have to start to think that the end game, and if you've had people talk about the fourth turning before, there's an optimistic end of the fourth turning. It's just you have to get through kind of this dystopian period right now, which is what we're going through.
Every market cycle reaches a point where investors begin to question the very assumptions they entered with, and this cycle is no different. Bitcoin has spent most of the past year rising, shattering old resistance levels and pulling liquidity from other asset classes. Yet many investors are deeply unsatisfied. The price action feels inconsistent with the promise of the cycle. The new all-time high of $126,000, historic in every objective sense, still feels too low, especially when so many early predictions floated numbers anywhere between $250,000 and $1 million. In cycles past, sentiment would be euphoric at levels like these. Today, it's subdued. According to macro investor Jordi Visser, that feeling isn't a coincidence. It's a consequence of a much larger psychological and structural shift taking place across the entire financial system. Jordi argues that this unusual sentiment gap is not just emotional, but engineered. The fiat system, especially at a moment when inflation is entrenched, government debt is exploding, and political volatility is rising, depends on people distrusting alternatives. When retail investors feel discouraged about Bitcoin, when they believe the bull market has underperformed or that the cycle is ending early, it reinforces faith in the legacy system by default. This is why the institutions benefiting from the current monetary structure prefer a market where crypto enthusiasm stays muted. Jordi believes they are winning that battle right now. Sentiment indicators show some of the lowest levels of optimism seen at this stage of a major Bitcoin cycle, even while Bitcoin trades above $93,000, a valuation that would have seemed impossible only a few years ago. Yet beneath that pessimism, Jordi sees data pointing in the opposite direction. Market structure signals, long-term holder behavior, and historical volatility patterns suggest that Bitcoin is not topping, it is coiling. Instead of being late in the bull market, Jordi argues that we are early in the phase where crypto eventually breaks free from macro headwinds and institutional pressure. He points out that each cycle has a suppression window where negative narratives dominate despite strong structural fundamentals. In his view, the dissatisfaction investors feel today may end up being the most bullish signal of the entire cycle. In his latest interview with Natalie Brunell, Jordi lays out his views on institutional behavior, macro timing, the future of the U.S. economy, and the technological acceleration driven by artificial intelligence. If you want the complete picture and understand why this cycle is unfolding so differently from what you expected, make sure you stay with us until the end of the video. And if you appreciate deep, grounded analysis from real market experts, hit the like button, subscribe, and turn on notifications so you never miss out. Thanks, and enjoy the video.
The way that I write is really geared towards the odds in the market. And this is something that comes from my background, from my father teaching me how to handicap horse races when I was a kid. And so what I'm always looking for, the long shots. And when sentiment gets really bad, there's usually a good opportunity to put money to work. So the question for me was, why is everyone so negative when at the time when this really started, it was still outperforming the S&P 500. It wasn't bad. It almost was like an entitled problem. And to me, in talking to people, and it was after Mike Novogratz on the Galaxy earnings call mentioned that they had one seller who sold $9 billion of Bitcoin. And to me, in listening to an interview he subsequently did where he talked about it, he also talked about people that would sell to bring in income, especially out of Asia, and that this was a part of the process that went on. And I started to really think about the fact that I think people are missing a big picture here, which is the people who are selling, based on everything I've heard, are long-term holders, and a lot of them are dormant owners who haven't had their coins out in the market for a long time. And that's really like an IPO. So an IPO, you have a lot of VC people that invest early in an idea. And remember, they lose in a lot of these. So these are situations where eventually they need to monetize. And that's what it felt like to me, was people were getting too negative and they needed to calm down. And the reason they needed to calm down is because I literally feel at the same time that we're at the beginning of a major bull market in the space because of the government and because of the innovation now becoming more relevant at this time. And so it just felt like that's what happened with Google and Salesforce.com in 2004 after the dot-com bubble. And so all of that just kind of bubbled to the surface. I started to write it. And like I said, I'm surprised that people embraced it so much, but I'm glad they did. So I think we're at the beginning stages of the network effects. So I'm going to use a technology side for this, but I'm also going to try to give your audience a different way of thinking from two camps, and using one part, which is what I hear a lot of people talk on your show and other shows about, the need for, let's say, liquidity in the market, which is historically been associated with leverage. So let's put QE, weaker dollar, liquidity in one camp. So you'll see these liquidity charts going up. So that's one side. And then the other is Caitlin Long, who I know, and we've had conversations, but she has a very different story about the importance of Bitcoin at this stage. And this gets into the velocity of money. So on the one side, we've had tremendous leverage that have entered the system over the course of really the last 20 some odd years. And the first baby boomer retired around 2011. And so when you start getting into the point, the transfer payments from the government have been going up consistently since the great financial crisis, but they're going to continue to grow because the government has to give people more social security and promises that they made. And so that's something that people focus on, like Bitcoin's going to go higher because we're going to get more leverage and we're going to go through. I actually think over time, part of the story for Bitcoin and crypto is that leverage is going to come down as more money transfers from the fiat system into the crypto world. And the reason is because a lot of the, let's say, tokens in the fiat world are dormant. So a dormant token is private credit, it's private equity, it's VC, it's real estate, it's illiquid assets that never trade. What Caitlin's talking about, and what I think people need to embrace, is that we're at the beginning of tokenization. Tokenization to me is the ability of anyone who has a dormant asset in the fiat world being able to transact in it all of a sudden, that there'll be a market for all of these components. So Bitcoin fits into this because the digital economy and the financial guardrails are dependent on crypto. And every year this is going to increase. The reason this year, in my opinion, that it's been kind of a frustrating year is not just the insider selling, the OG selling, which is they should be doing. They're overweight an asset. There's other things to invest in innovation now, AI. But I think the other problem that's come in is that people forget the hangover from the crypto winter that is still there, and the fact that the VC world is still trapped in bad investments from them, not only in that, but in SaaS, which has also been disrupted by AI. AI has been a focal point for people, and it gets lumped in with innovation, which means it gets lumped in. At the end of the day, Bitcoin is innovation. It's a story that doesn't have fundamentals the way the traditional finance world is used to. It has a narrative. And unfortunately, that narrative is very difficult for the traditional finance, which matters a lot to the ultimate value of Bitcoin, because those people live on narratives. They live on stories. They live on something. And if they have an innovation story, they don't need Bitcoin. Now, they're buying all the time because the ETFs continue to have inflows. The treasury companies continue to expand. I'm sure governments will continue to put more money in, but the OG sellers are getting out. So that's where you get that kind of IPO feel. I think going forward, one of the things that I've written about outside of my Substack, actually I did write this in my Substack, is I really made a point to emphasize to people that AI is electricity. Electricity is not an investable technology. The same way AI theoretically is not an investable technology. I don't believe in the Magnificent Seven taking in enough revenues to justify the CapEx. It's not that they're going to collapse. I just don't think these are growth names anymore. I think they're spending an enormous amount of money. So we need the narrative of those names to actually slow down, and then for investors to look for growth. Have you had Rick Edelman on your show?
I have, yeah, recently actually.
So Rick talked a lot about having 10 to 40% in crypto. The reason, or one of the primary reasons he gave, is connected to artificial intelligence, which I will tell people is going to be a major story next year, which is this whole thing of longevity and extending people's lives. And that they need to have, because of that, more money in growth parts of their portfolio, which means more innovation. AI is like electricity in the fact that every company, whether it's a bank, whether it's a healthcare company, they'll all benefit through reducing expenses. That is very powerful, but there isn't a technology company, in my opinion, even though people speculate on it, that'll benefit. NVIDIA is a commodity company. They make something that goes into to help AI go. So I think your point is the most important question that people probably don't think about, which is the opportunity cost for people to invest in Bitcoin. Anyone has two parts to it. One is price. When price is going higher, everyone's happy and they're buying more. Mm-hmm. When it's going down, there isn't like a fundamental story that you can hang your hat on. And so that scares people. Like, when's it going to stop? It's just kind of like in a dark room. Mm-hmm. I think eventually people will be more apt to buy it because they go, well, I know what's going to happen is there's going to be more digital wallets created because of tokenization, because of stable coins. Once there's more wallets, it's much easier for the traditional finance people to actually invest in Bitcoin.
To wrap up the first part of Jordi's argument, he makes a clear distinction between price action and perception. Prices are high, liquidity is improving, and institutional flows remain strong, yet the average investor feels defeated because expectations were set unrealistically high long before the cycle matured. Jordi stresses that Bitcoin trading above $93,000 during a period of broad economic uncertainty is not a sign of weakness. It is evidence of structural strength. It only feels disappointing because retail was conditioned to expect a parabolic explosion by now. And historically, when sentiment is this misaligned with fundamentals, the market tends to break to the upside with more force than anyone anticipates. From here, Jordi widens the lens. He examines how AI adoption, underlying U.S. economic trends, and structural labor shifts are influencing asset prices in ways most investors are not yet accounting for. He argues that the same misunderstanding shaping Bitcoin sentiment is also shaping perceptions of the broader economy, particularly around growth, productivity, and capital allocation. And it's in this intersection, Jordi says, where the real opportunities begin to emerge. Because if Bitcoin sentiment is artificially depressed, and if the U.S. economy is stronger than headlines suggest, then investors may be misreading both sides of the equation. All of this sets the stage for Jordi's next major point, one that dives directly into how AI, consumer behavior, and macro resilience are about to reshape capital flows in 2025 and beyond.
Can you talk a little bit about how to invest in AI if people are looking for opportunities? Because sometimes I hear that it's a bubble and it's going to crash.
I hear that every day.
Yeah.
And I don't think it'll stop. First of all, there are pockets of bubbles inside the investing space, and you've seen some of these names fall 60%. And I'll just give you an example. Nuclear, to me, has been a bubble. It's not a bubble anymore because it's already fallen down sharply. I don't think nuclear is a very safe investment. And the reason is because you're not going to actually see any revenues for a long, long time because it takes a long time for the build out. So to me, that is a bubble. And a bubble just means where things get overvalued. And there's pockets of that. I don't think people should treat artificial intelligence as an either or, meaning it's a bubble or it's not. This kind of connects us back to prediction markets, meaning there's really no answer because it's a word that doesn't mean anything unless it crashes and people see there was a bubble. I think people are going to keep calling it a bubble for two reasons. One is there's unprecedented spending, some of which is going to be worthless. There's no doubt about it. I don't think it'll ever take down the economy, which is what people should care about, which means the benefits from AI far outweigh the risks. Do I think the company spending the money, you should be very, very wary? Yes, I do. And I posted on X about something with CoreWeave, which just disappointed investors. I think there are pockets of bubbles. I think the more important thing is the value that comes from it, which was the other part of your question. Banks are going to benefit a lot from it. And the reason is because the coding element of it is very, very good. The AI agents are going to start coming in now. So digital employees and the ability of replacing employees, which is a profit margin story. I've compared artificial intelligence to QE for the stock market. The stock market was driven higher by QE because we moved rates to zero. That allowed companies to issue debt and buy back their stock, which makes earnings per share grow. For artificial intelligence, you're actually taking it off the bottom line. So the expenses are going down. That actually has operating leverage on top of it. So healthcare names, financial names, a lot of different places will benefit from AI.
Where are these people going to work if the AI is going to take over all the white collar jobs?
All right. This is a problem that I spend a lot of time on, and I'm sure a good portion of your audience has children, as all audiences do, and they're worried about their kids in terms of what the future is going to look like. So let me bring a dose of reality and a dose of optimism.
Okay.
I do this every week on my YouTube channel to kind of hopefully show people that, number one, artificial intelligence is disrupting the jobs market. What doesn't really get brought into the equation, though, is that this has been going on since the smartphone came out. It doesn't get associated with it, but we started after the great financial crisis with an unemployment rate of 10%, and it obviously went down. But part of the reason it went down as much as it did is because we also saw the labor participation rate collapse. Now, part of that came from demographics and just people retiring, but part of that came from people not needing to work as well. And the reason I say they didn't need to work is because when the stock market goes up for 10 years, that means people are getting wealthier. Household net worth has gone up significantly since the great financial crisis, and it's up about $80 trillion since the depths of COVID. It's 180 trillion, and 80 trillion of the 180 trillion for the United States of America in terms of its net worth for households came from the bottom of COVID until now. So people have accumulated a lot of money through the benefits that have come from this disruption. Now, that doesn't help the kids. Peter Thiel had a viral thing going around last week, which you saw, just highlighting. Now, that was 2020, which means this problem is not something new. The move by kids to more government handouts, the voting that we had in New York City in terms of going towards socialism. This is not just about AI, and it's also not just about the decade before. It's about student loans. It's about the corporate ladder being kind of destroyed. And if I don't have upward mobility and I have all this debt, it's not just how much money do I have today? Can I actually make more going forward? And then the government gave a lot of handouts in 2020, 2021. People spent that money when it should have been going towards with the eventual inflation that came. So I think the optimistic side is this. I do believe the deflationary impact from AI is going to help people, because if their wages are up at a certain level, part of the pressure comes from the inflation side. The inflation has been a major, major problem because health insurance, car insurance, all that has gone higher. And I do think for younger people, AI is going to help on the deflationary side. And I do think younger people have a better chance to learn from AI and actually become entrepreneurs. But this will be the age of entrepreneurism. And this is one of the reasons why on my weekly video, I spend a lot of time trying to help the parents think about, how do I have my kids become entrepreneurs? Because that's the world we're going into. It's the age of entrepreneurs.
So you're not encouraging them to become welders and engineers and HVAC operators, because those are the jobs that can't be replaced by AI, right?
For the near term, because the build out's going to be so real. Humanoids will come eventually and they will be able to do those. But I do think for kids that, my father was a construction worker. He was a core driller. I think if you want to go make $150,000 to $200,000 right now, which is more than, and gives you the ability to live on something, if you can be a welder, an electrician, a plumber, we're going to need lots of those. We have shortages for them, and go for it. You know, I'm a student of history. Joseph Schumpeter is an economist from a long time ago who wrote a book called Creative Destruction. And within that book, he talked about how capitalism and innovation, and you got to think, this is back to the 1940s, his forecast was that eventually we will reach a point where it will consume itself. And what he meant by that is exactly what we're going through, which is at some point capitalism gets to the point where very few people are benefiting. The government needs to offset the deflation, and so they keep this thing going. The stock market becomes such a big part of the economy that they're not allowed to actually have a recession again. And that's where we are. And then he eventually said that people will migrate to socialism. So this is kind of the innovation backdrop. So I don't want to in any way, shape, or form. I talk about how the jobs market's going to be weak going forward. The anxiety over jobs is going to remain for the foreseeable future. And not until we get the deflationary benefits from AI will you start to see the K start to work out. In my vision, 10 years from now, one of the reasons that I think Bitcoin does so well, if Bitcoin is for people who don't believe in the system, you actually need the people who are benefiting the most from the system to need to not believe the system. They still believe the system because they're making lots of money. The people who call this a bubble, they're all people at the top end of that scale. Mm-hmm. The people at the bottom end are saying, I don't even know why this is going on. There's nothing good happening. So I agree with what you're saying. I just think people have to start to think that the end game, and if you've had people talk about the fourth turning mm-hmm. before, there's an optimistic end of the fourth turning. It's just you have to get through kind of this dystopian period right now, which is what we're going through.
Jordi argues that the fiat system is intentionally designed to reward pessimism because pessimism keeps people dependent on the safety of the traditional financial rails. But pessimism has a shelf life. As inflation trends downward, as technological productivity accelerates, and as capital begins reallocating toward innovation again, the spell of forced negativity weakens. When that moment arrives, Jordi expects Bitcoin to break from its current range with a speed that catches even long-term believers off guard. In his view, the compression phase is ending, and the era of restrained price action is giving way to a more dynamic phase of adoption and growth. He reinforces this point by connecting it back to the broader macro landscape. AI, automation, and efficiency gains are not just transforming businesses, they are transforming how value is created and where investment flows. When productivity rises, it reduces inflationary pressure, increases economic throughput, and forces capital away from stagnant sectors and toward high-upside innovation. According to Jordi, this is exactly the kind of environment where Bitcoin thrives, one that rewards long-term conviction, punishes short-term emotional trading, and amplifies assets that benefit from technological acceleration. For him, Bitcoin is less a speculative punt and more a structural beneficiary of a world moving faster than traditional policy frameworks can adapt. And that's why Jordi's message is ultimately optimistic. Yes, sentiment is low. Yes, prices have underperformed sky-high expectations. And yes, the cycle feels confusing. But underneath that discomfort lies a market preparing for its next major leg. One driven not by hype, but by fundamentals, structural forces, and long-term technological change. If Jordi is right, the phase we are entering now will reward clarity, patience, and discipline far more than fear or frustration. And let us know in the comments whether you agree with Jordi's outlook. So if you found this breakdown helpful and want to stay ahead of the next moves in Bitcoin, crypto, and the broader economy, hit the like button, subscribe, there's much more to come, and we'll continue following every major update as this cycle unfolds. Thanks for watching.